The AAVE damage did not stop at the exploit trigger. Forced liquidations turned a risk event into a faster market unwind. This matters because liquidation cascades change how price falls. Instead of steady selling, the market gets hit by forced exits that can push a token through support before buyers have time to reset. The tension is whether the supported catalyst is strong enough to survive the first reaction and keep drawing buyers once the easy excitement fades. The article said rsETH-linked collateral stress spilled into AAVE and led to market freezes across affected rsETH markets. It framed the main demand zone around roughly $88 to $92 and said a break below could expose $85 and then possibly $80. AAVE price drops is the phrase tied to this setup, and this matters because liquidation cascades change how price falls. Instead of steady selling, the market gets hit by forced exits that can push a token through support before buyers have time to reset. Those confirmed details matter because they tell you whether this move came from one headline or from several pressure points landing together. Open interest began to rise again even while price remained weak, which the article treated as a sign of fragile positioning. When liquidity tightens and leveraged positions start failing, forced selling can hit the book in waves. Each liquidation pushes the price lower and makes the next liquidation easier to trigger. A liquidation cascade means falling prices trigger forced selling, and that forced selling then drives prices down again. That mechanism is the part traders can miss when they only look at the chart. That affects traders using leverage, but it also shapes how spot holders interpret price because forced unwinds can exaggerate a move beyond what organic selling alone would do. This is why the move can look larger or weaker than one headline suggests. In stories like this, the structure underneath the price often matters as much as the candle itself. The market knows the initial trigger, but it does not yet know whether fresh positioning will stabilize the chart or simply set up another squeeze lower. For searches like AAVE price drops, the market knows the initial trigger, but it does not yet know whether fresh positioning will stabilize the chart or simply set up another squeeze lower. A market can move before those answers arrive, but it usually cannot keep the same pace forever without them. The important point is that price action and structure are not the same thing. A sharp move can be real while still resting on fragile conditions that have not been fully settled. That is especially true when leverage, concentration, or technical positioning is doing part of the work. Watch whether AAVE can reclaim the $95 to $100 zone, and whether rising open interest starts to support recovery instead of building pressure into weakness. Timing matters here because the next clean signal can separate a durable move from a temporary burst. If that signal confirms the story, confidence can rebuild quickly. If it fails, the move can unwind just as fast. The broader consequence is that traders are not only pricing a chart. They are pricing confidence in the mechanism underneath the chart, whether that mechanism is supply, leverage, collateral, or narrative follow-through. That is why this story matters beyond one intraday move and why follow-through is the real test. AAVE price drops is the phrase tied to this setup, and watch whether AAVE can reclaim the $95 to $100 zone, and whether rising open interest starts to support recovery instead of building pressure into weakness. The practical takeaway is simple. Watch execution, watch the key level or flow that matters in this story, and do not treat an early move as proof that the final answer is already known. The market still has to validate it.